All right, day two. So yesterday we talked about the basics, okay? And I know that it can seem like it's not enough information and it's just such a beginner thing for a lot of you that understand how volume is executed and things like that. But I assure you, if you don't understand the foundation from yesterday, then it's going to be very difficult to move forward because the pace is going to change very rapidly here. So, pre-market, I think we had a pretty good lesson about um, volume and how we couldn't trade volume at the bid unless a price moved up and the bid was actually that price. Um, you know, think about the slide we did yesterday with how the market auction process and what it takes to move price up or down. Those are very important things because when we start getting into looking at trading patterns, it's very easy for you to forget about the fundamentals and just say things like, well, the high volume mark was at the low, and so that means that it's responsive buying, and to forget that there's other components that will comprise this. So today we're going to talk specifically about those patterns, how we formulate a set of rules to buy or sell, and I want to be very clear, it's going to be a tad bit limited today in that regard because we have to get you to tomorrow where we talk about targets, stops, and making sure that risk to reward adds up. Okay, and then the next day we're going to talk about the best places on the chart to enter a trade. So today I want you very focused on the amount of information that we're giving you, the rules that we're giving you for when we find it acceptable to enter a trade off of, or to consider entering a trade off of responsive buying, responsive selling, sellers initiating trade, buyers initiating trade. Okay? We have four basic patterns. All right, four basic patterns, and then if something doesn't fall into those patterns, it's a good sign that you want to stay out of the market. We call that two-sided trade, okay, where both buyers and sellers are assuming that there's some sort of value in the market, and that's when we get into things that people call chop, or a lot of what we've seen the last 2 days. Keep in mind that what we're doing here is an extremely short-term valuation process. That should be valuation, not evaluation. Guess the spell check caught that or something, but valuation process, okay? We're looking at things very, very short term when we're looking at the order flow. So we can't make 100% of our trading decision based on what we see on the order flow alone. All right? That's why this is not set up as some auto trader, because if all we needed was for there to be a responsive buying or a responsive selling pattern, then we would just have the software automatically execute for us, right? But this is one piece of the puzzle, and we have to understand what we're looking at so that we can compare that to other pieces of information. So we can say, yes, not only does it look like the buyer or the seller has exhausted their effort, but this is also at a place where I want to engage the market because I feel confident that other commercial traders will do the same thing. So what we're talking about here is one piece of the puzzle, and you have to keep that in mind throughout today and tomorrow, because Thursday you'll be given the other piece of the pie. Four basic patterns. Everything that we're going to do is going to fall into one of those four, and if it doesn't, it means that we're not interested. Okay? We can classify these as either counter probe or against the momentum, which is primarily how I've been trading the last 2 days, relatively without much effect. Okay? Or we can classify them as momentum trades, where we're looking for the price action to create a continuation or a breakout or a breakdown. Now, what we're going to be doing today and tomorrow is a transition from the way that most of you think about trading and trade execution and the decision-making process. Okay? With the exception of a couple of you who are pretty well versed in some form of order flow or at least a lot of experience with time and sales, for most of you this should be pretty new. I mean, I kind of put myself out on the forefront of this type of trading in this industry because there's not much out there that does what I do. And so it's crucial for you to take this as a complete educational experience, and I want you to start stepping away from some of the things that you are used to saying or some of the things that you associate with the market. Keywords like support and resistance and breakouts and breakdowns and chop. Okay, those are words that I don't want you using anymore. All right, I want you to start thinking like a professional that reads the order flow. Okay, we don't see resistance. Okay, we see an opportunity for responsive selling. We don't see support. We see an opportunity for responsive buying. We don't see a breakout coming. We see buyers initiating trade. We don't see a breakdown happening. We see sellers initiating trade. We don't talk about trends. We don't talk about chop. Okay? It's not just that I don't want to hear it. It's that I want your mind to be in the right place. You've taken the most important step, which is saying, I want to learn this. So let's learn it and let's get absorbed in it. Okay? Different way of thinking of things, because what's important is that you don't associate something as support. You associate it as a condition. Okay? And we're looking for that condition to form, and we're looking for that condition to take place. And if we get into a trade because that condition exists, we better be able to respond if that condition no longer exists. Okay? So we may put on a trade and then say, you know what, it doesn't look good anymore. I want out of this. Right? That's a whole different way to trade than for most people. They just wait for a signal and say, okay, it told me to go long, and I'm going to use a 2-point target and a 1-point stop. Okay? Well, there's a reason that that's ineffective. Right? It doesn't utilize anything other than some basic spreadsheet function. And I'm going to tell you, like nature, there's no straight lines in nature. There's no perfect spheres, or at least for the most part. Okay? And the market's the same way. It doesn't fit into a box. You can't use something that fixed and have no flexibility. You need to be flexible in the sense that, and I don't mean subjective. Everything that we're going to show you, you can formulate a set of rules for. But what I mean is, we're going to get you to a level where you're confident enough to spot these patterns. And so if you're confident enough to spot them, you should also be confident enough to spot when they no longer exist. And that's what separates us as discretionary traders. Okay? The ability to make decisions and stand by them as long as the data still adds up. And not just saying, well, my little formula all came together, but it didn't work. Okay, well, there are going to be some that don't work. But that's not our objective. Our objective is to be with the profitable trader. Okay, and we all know who 90% of the time is not the profitable trader. Right? The average retail trader loses, 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 loses. I don't want to do what he does. I'm not interested in what he does, or the words he uses, or the way he describes the market, or what he thinks support means, or what he thinks resistance means. I'm not interested in that. I've elevated myself, and it's time that you do that too. So this is the first day where I expect you to start that, and we're going to go through a lot of patterns today, and I need you to be interactive. I need you to call these out. I need you to, and I'll give you the easy way to type this out. I need you to be engaged in this, because it's the only way that we're going to get from point A to point B. Now, I highly suggest printing today out. Print out the slides, which are posted in the shared folder. The reason, and there are a lot of them, and I apologize for that if any of you are worried about killing the trees, or your printer for that matter. But the reason is because my expectation is that we're going to go through this once together, and you need to set aside time to go through these patterns on your own, kind of as flashcards. Okay? You need to do that, because the more that you see them, and even though they're after the fact, they're past tense, the more you see them, the more you're going to understand what creates a good trade and what creates a trade where there's more jeopardy. And particularly when we go into this tomorrow, we'll do the same thing, but with an added factor, which is you understanding what every single trade is going to cost you to make you. Okay? Which is something that most novice traders have no idea how to do that. They just associate it with, well, I made a spreadsheet and I said my stop is going to be 1 point, my target's going to be 2 points, and I hope I get there. Okay? Well, that's not going to work. We can show you how you can put those probabilities on your side. And so focus on this today. Tomorrow we'll add another component. And by Thursday, we'll be looking at the broader scope of the market. By Friday, all of this is going to come together very nicely for you. First pattern that we're going to look at is responsive buying. This is what we would be looking for when most people would assume there is support in the market. Okay. The first identifying factor of this is that we need to have sellers in control on the way down. Right? And how do we know that they're in control? Well, I mean, other than the fact that the price has obviously gone down. Okay, we know that they're in control because for the most part, if we look at the corresponding volume at the ask versus volume at the bid, the volume at the bid is significantly larger. Okay, not all the way down, but for the most part. You know, 851 against 23, 768 against 200, you know, that type of thing. 1261 against 560. Right? Obviously, the sellers were driving the market. And if you can associate with what we talked about yesterday, imagine that there is 800 or 900 contracts in the market depth at any given price level. And we start to see the market tear down with 851, 768, 659, 1261, 897, 1104. And this was probably a pretty rapid move down through the market depth. Okay? And so what we see here are sellers that are in control. They're not having any, there's no more demand coming into the market depth. They're simply driving the market. Okay? Now, one of the first things that we're looking for once we establish that we've got a probe down is whether or not the sellers are able to continue pushing down. And some of the key factors that we're going to look for are a big shift in volume. Instead of volume being up at, keep in mind what that purple line represents. Okay, it represents one price level, but yesterday's lesson was about understanding a volume cluster. Okay, or 2 or 3 consecutive price levels that hold the majority of volume within a period. And a period represents an auction. This was an auction where the sellers auctioned the market lower. Okay? So if the majority of volume has now taken place at the low, then we have a lot of sellers who have come into this after the majority of trade is, the majority of the movement has taken place. Now, it's easy in hindsight to say, yeah, the high volume is all the way at the bottom because the purple line's there. But I want you to think about where this opened. Okay, this period or this auction opened all the way up at the top where it says 319 and 525. That was the first tick of this auction. Whatever started it, whether it was the opening tick of the morning or a new probe or whatever. This is the only information that we have right now. So that's where it opened. Okay, so as it ticked down 3 levels, we see 2182 against 3034. Doesn't it stand to reason that at that point in time, the high volume purple line was there? Correct? Would everybody agree with that? Okay, so as we see this develop in real time, obviously, at some point, the sellers drove through the highest volume point and took control of this, right? They started driving the market down. And once we get on the other side of that 2100 and 1600, that's really where we see the point where we can imagine, because that's all we can do in this case, right beyond that where we see 851, 768, 659, that's probably where the seller really started just cutting through the market depth. In other words, no more demand was put into the resting limit orders, right? We just exhausted the market depth and kept driving straight through it. All right. So obviously that's where the seller had engaged the market. And as the seller has a fairly easy time driving the market down, suddenly we get down to a price level where it no longer takes 800 contracts to trade through the market depth. We can see 1200 build to 2200 and then build to 4100. Okay? 4100 contracts in comparison to anything else in here. And let's take a couple of price levels because we're really looking for the volume cluster, right? So just on the sell side alone, we have what in 3 or 4 price levels there, we have maybe 10,000 contracts going short, give or take. Okay, well, nowhere else in that period do I see anything like that in consecutive price levels except for all the way at the top, which was probably originally the high volume, 2182 and maybe 1687, right? So we see this shift in real time. Okay? At one point, this was heavily weighted on the top. But as this period's being created, we see this shift. We see that purple line in the volume cluster move to the bottom. Okay? That's an indication to us that something might be happening. Right? With no other information, we don't know if everything's going to reverse and take off the other way. But what we know right now is that there are an awful lot of sellers that are in the market. Okay? A lot more than came in at any of the places where those sellers are profitable. There's a lot more that have come in short. And what we know at this point is that because we've now upticked 2 price levels above where the bulk of those sellers are, that we've got a lot of shorts in the market that aren't getting paid. Now yesterday there was a good question asked. How do we know if something is somebody physically going short or if it's somebody selling to get out of a long position? Well, we don't. And we don't have any way of knowing that other than the fact that we know that this trade was executed at the bid price, which tells us intent. Okay, so they very well may be getting out of a long at market, but it would stand to reason that if they were in profitable longs, they would probably be trying to carry them, you know, as short as possible. Okay, and all we can do is assume that even if it's 50%, let's say that it's half and half. Let's say that half of those are new positions. It's still more trade than anywhere else on this entire auction, except for the very top, right? So what we can assume is that we've got a lot of trade that came in late. And I'll tell you when we see this. We see this when we've been consolidating, and then suddenly the market starts to take off, and we break down, okay? And what happens? It triggers all kinds of sell stops. Oh my God, it's finally broken out. I'm short, I'm short, I'm short, I'm short. Right? And what usually happens when you do that, if you've ever taken that path? Usually as soon as you get short, the market upticks about 2 points. Stops you out. Okay? Somebody made a comment earlier today, how does the market know where my stops are? Well, if you're with the bulk of trade that comes in late after other people are already taking profit, then you're typically coming into a situation where the profitable trader has been distributing contracts all the way down and is ready to buy them back up. Okay? So we have this imbalance down here where we have a lot of shorts and they're not getting paid. And we know that it's not going to take very much for them to get antsy about it. You know? For the most part, we'll expect that a novice retail trader will be using somewhere between a 1 and a 2 point stop, usually about 1.5 points. It's all they can take, and particularly when you sell the low. Come on, guys, I've sold the low before. You know what it feels like. You get so excited because you think the market's running, and then what's happening? What's happening? Why am I short at the very bottom of the market? And that adds to your fear factor. And maybe where you may have been willing to take a little bit different stop, you start thinking, if it'll just get down a little bit more, I'll get out of this, right? Get antsy. And what happens is these sellers that come in late, these are not the guys that are in the money. They're out of the money. And they get trapped down there, right? And we'll start to see those shorts come out. If you're short, the only way to get out of the market is to go long or to buy. So we basically have a situation where we've got people stuck upside down getting out of a position. And the only thing that makes the difference after that is whether the market maker then comes in and starts buying up or just simply reinstates shorts to drive back through after you've come out of the market. The rules that we look for when we're looking for responsive buying. Okay? When we're looking for this, number one, we're looking for a period dominated by sellers. And the second thing is that we would prefer to see light volume within the upper prices. Now, I want you to take a note here. Not light volume meaning small numbers. It's all relative. Because if we look at the volume that's traded at any given price level today versus what you're looking at on the screen, they're completely different. Okay, but one doesn't indicate that something's any bigger than the other. If I look at the live screen, I can look at several price levels in the same period that have 6, 7, 5, 6, 7,000 contracts in it, on one side. Okay, well, is it large? Not if everything in the period has 6 or 7,000 contracts, right? Large would be the 12,000 versus the 4,000. So it's all relative to what you're looking at. Question, well, what is light volume? Okay, well, in this particular case, all of the volume is 400 or 500 contracts or less. And then suddenly down at the bottom we see 2,300, 1,700, tremendously different, right? 3x. All right, so we want to see that the volume above us has been fairly light, and there's a reason for that. And it has to do with our risk versus reward, which we'll go into in depth tomorrow. But the idea is very simple. If you can imagine that up where the 195 and 213 and 527 are on the bid side, if those were numbers like 1,800, 1,700, 2,200, then it would indicate that there was a lot of selling that took place there, right? Whereas very light above it, then a lot of selling, and then light below it, it would indicate that that's where sellers initiated trade, okay? Or a breakdown began. And so by not having heavy volume up above us, it tells us that if we're correct about our assumption of this coming together as a reversal, that it's not going to be very hard at all for them to drive the price up very quickly. Okay, and we'll go into that in depth tomorrow. The third thing that we obviously need is for the volume cluster to shift down into the lower end of this, specifically into the bottom 3 or 4 prices. Okay, if we can get all of them trapped within about the bottom point of an auction, then it becomes very easy to tip it over. If it's any higher than that, it's easy for them to trade back through it and create a situation where we might see a breakdown, which we'll go through in just a minute. Okay, so that's the third thing that we're looking for, is we've got to see that volume shift. We need to see the bulk of trade happening down at the bottom. All right. The next thing that we want to see is we want to associate this with the commitment of traders, okay? Because granted, we've had this great move down and we've seen all this trade happening at the bottom. But if we can see that there's all of this late trade and yet buyers are coming in on the other side in bulk, well, then that tells us that all of the components that we're really looking for are there. Okay? We need to see the seller no longer actively selling. We need to see an increase in demand, which means that the high volume will shift down there, and we need to see an increase in the market demand, which would be the commitment of traders being positive. Now, this slide says greater than AMD, average market depth. Okay? People tell me, well, what's the magic number to look for? I want you to look at your market depth. Right now, over 5 price levels, it's about 7,200. Okay, so a little bit more than 1,000 at any given price level, right? I'm sorry, that's 5 price levels. Okay, and I can see it, it's like 1,100, 1,100, 1,400, 1,900, 1,900. Okay, so if I look at the market depth above me and I say, what's it going to take to move the market through one price level? I gotta have at least that many market buyers actively coming in and hitting it, because they're going to amplify if they get on top of something. They're going to amplify quickly. Okay, so I want to know that the market buyer has started to come in, and I want to know that he's come in with at least more than that. And the reason that that's a good number for you is because pre-market it may be 600. In the bulk of trading in the morning it may be 1,500. In a situation like we were in right before 11 o'clock, it could be 4,000. I mean, it was ridiculous. Every price level had 3,000 contracts resting at it. So I can't give you some hard number and say, this is the magic number, because it can't be static. The market's not static. Okay? So we need the commitment of trader to be larger than the average market depth. Well, no, not really. We're looking for the bulk of trade being there. I mean, obviously, Eric, I'd prefer to see a lot of buyers, or a lot of trade at the ask if I'm looking for a buy. But it's typically not going to happen. The reason is because on the way, by the time you recognize this as a trade, what we don't want to be is 5 or 6 price levels off the low. Then it puts us into a situation where our risk to reward is going to be upside down. Okay. So I wouldn't focus too terribly much on that. You make a good point. The question is, does it matter if the high volume is on the bid or the ask side? But really what we're looking at, and this is the difficult part for a lot of people, when we're interested in where the majority of trade is taking place, I'm interested in as a whole, okay? Because I just can't divide it up into, is there more sellers or buyers because the exchange that happens on the way down, whereas up above where we have very light trade, it went straight through those numbers, I guarantee you. But when it got down to the bottom, it's accumulating, right? Because it's not trading through it very easily. So unless you can keep track of how many come in after, one after the other, it'd be pretty difficult. In other words, we may have seen 1,000 against 200 on the way down, and then on the way up, we printed another 1,800 on the ask side and put 2083 there. So I wouldn't worry too much about it. Obviously, we don't want to see a huge imbalance like we saw earlier today, where there was, I think it was something like 13,000 on the buy side and 4,000 on the. I mean, something that looks significant might be a little fishy. For the most part, I wouldn't worry too much about it. Today was a little bit of a anomaly in my book. Okay, the next thing, and this is important, and I want you to take this with a grain of salt today. It's important. But Thursday is going to be all about this, okay? Thursday is going to be all about this. So let's not harp on this for too long. Presumable support level, okay? I'm going to explain it in a minute, but we have to remember that the market auctions all day long, okay? And it doesn't, with the exception of maybe this morning, it doesn't really move in a straight line anywhere. So all day long there's going to be probes and rotations and probes and rotations. Okay? And if we choose to engage every time that there is something going on, inevitably we're going to find ourselves upside down more than we want to be. Okay? That's why I say this is one piece of the puzzle. We're utilizing this to understand where our best entry could possibly be, where the most logical stop is, and then where the most logical targets are. Okay? But that doesn't necessarily mean that every time that we see a pattern, we're going to enter the market. And the reason is because what I want to do as a trader, and in the world of trading, I'm a very small trader, okay, in comparison to any prop house or commercial trader. I'm tiny, okay. So I want to position myself in areas where I know more professional traders are going to be engaging the market. It's the difference between the day trader that's looking at a 150 tick chart to make all of his decisions, and somebody who says, I'm going to look at the daily chart, the 60-minute chart, the 15-minute chart, the 5-minute chart, and I'm going to look for a convergence of things that I can recognize. Okay, one's got a totally different approach, and what he's trying to do is match multiple time frame traders, which is a terminology that gets thrown around a lot, and I may have a different definition of it than most, and we'll get into that on Thursday. But the idea is very simple. If we respect the fact that there are thousands of traders in this market for thousands of reasons, then we have to understand that not everybody is doing this tick by tick, right? So not every time that there's some imbalance or something does it warrant me risking money. Now, if the risk to reward looks right and I can't find any flaw with it, then by all means. But for the most part, I go through a process every day where I line out where I think the most reasonable levels for larger commercial traders to come in and actually push the market more than 2 ticks exist. And that's where I'm trying to target things. So we can put that on a much more simplistic level here in just a minute. The next piece of the puzzle, target an entry near the high volume. And when we see these patterns come together, I don't want to be long up where it's 570 against 28. okay? Because it's very likely, and we know it happens quite a lot, that we'll come back down and retest lows, particularly where we've found a responsive buying aspect, okay? So I don't want to position myself very far off the bottom. The whole purpose in trading from order flow is so that I can get entries 2, 3, 4 ticks off the bottom at most. Okay? I want the best possible entry because I want to use the smallest stop possible. So always be looking to wherever the high volume is for a judgment on where your entry is. Tomorrow when we talk about risk to reward, we'll go into more depth on that. Now, presumable support. The reason that I want you to just start thinking about this is because I'm getting a lot of questions throughout the day of, what do you make of this? What does this look like to you? Can you give me a read on this? And I appreciate that, sure. Okay, but to me, every decision that I make is based on a larger concept, okay, bigger picture. So in its most simple form, if I'm looking at the previous trading range that we've just established, so let's say from 27 up to 32.75 today. And this is the range we've traded from 32.75 down to 27. All right. If we trade up right now to the middle of that range, and I get a selling pattern, or I get a responsive selling pattern, it's going to be a little bit different to me than if we trade up to the top of that. And I can understand that it's very likely that we would have resistance up above. Or in this case, trading back down to 27, producing a pattern makes a lot more sense than trading to 28 and producing a pattern. So the idea is just, I want you to start associating, whether, pull up a 30-minute chart or something, just so you can start referencing where you're seeing these patterns develop, okay? Take a look and say, does it make sense that we traded down to this level based on what happened the last time we were down here? Right? And if you find yourself seeing something that's in the middle of where the last time that we found a buy response was, that's probably a lot better than finding yourself in the middle of a range where it's the last place that we saw the seller initiate trade. Okay? So just kind of to give you a basic start here is the idea that we're going to be looking at where previous transitions in the market took place to associate these patterns. Now, obviously, not every time that we have a pattern of responsive buying come together is it in fact going to reverse the market. If it were that easy, one, I wouldn't be selling it to you, and two, I'd be sitting on a beach somewhere and letting the computer do all this for me. All right. What happens is obviously there's an exchange that goes on when we reach these high volume concentrations. Okay? And it really comes down to who wins. All right? So if we have a period where it's dominated by sellers and they start driving the market down, and we see the volume shift down to the low, okay, then what we can tell ourselves is that essentially we've started a pattern of responsive buying. And the question is, will the buyers in fact respond? And will they initiate enough trade to bring the commitment of traders up to a respectable level and then reverse the market? Okay, and we don't know that. We have no idea. All we can do is have some guidelines, which I just gave you. All right, but if we start trading down and we see a lot of trade coming in and building up a huge concentration of buyers and sellers at the bottom, and then they're able to initiate enough trade to trade through that, then that temporary level of support that we were creating, or that temporary level where the buyers were responding, has failed, right? It's failed. And now that starts what most of you would call a breakdown. So when we see that we're able to get on the other side of a huge cluster of volume by more than about 4 price levels, then we can say, yes, the sellers came down, there was a slight buy response, they were trying to lift it back up, but the seller initiated enough trade to break the market down. Thus, the pattern is called sellers initiating trade, and it is exactly what happens when what you would call support fails. In this case, the traders that are upside down and that eventually drive the market into a fast frenzy are those that were buying rather than the sellers being trapped at the bottom. You can imagine if we had gotten along here and thinking that this was going to be a reversal, and I'm part of the 3,500 or 4,000 or 4,100 that are on the ask side, then certainly I'm going to have to get out of the market when it pushes my limits. And if I'm a normal average retail trader, that's probably going to be about 1.5 or 2 points. Now what happens if I'm long and I have to get out of the market? I have to sell, right? Well, if we're in a breakdown and sellers are initiating trade and then we hit stops that send off more shorts, what happens? It's like throwing gas on a fire, right? The market moves very rapidly. So the majority of time when we see the market really moving, it has a lot more to do with stops being triggered than new trade coming into the market. It's obviously a combination of the two. But you can imagine if you already have wild excitement to sell, and then you have a lot of stops going off, which are in fact sell orders, then we're going to see a tremendous amount of volume come through. Now the rules that we use when we're looking for a short opportunity from sellers initiating trade are these. We obviously have to have a period dominated by sellers. Okay? Now, whereas before we were very interested in having light volume above us because we were trying to go long and essentially didn't want anything to be difficult to trade through, you can imagine here the last thing that we want is heavy trade down below us. Because if the trade gets too heavy below us, the volume will shift, right? And then we'll be in a state of, gosh, now it looks like responsive buying again, right? So what we want to see is light volume below us as well. Right? The indication here is that if we trade down to where this, look at the first period here, if we trade down on fairly light trade, we're cutting through the market depth, and then suddenly we hit a point where it took a little bit more to trade through. And this is a very basic example. We'll look at some that are more relevant to the type of trade we're seeing. But we trade down to the 1179 against 819. We hold up a little bit, and then the sellers initiate a trade to trade through that level. Well, if we start trading very heavy trade down below, that high volume level is going to shift down, right? And it's going to start to look more like a responsive buying pattern. So by breaking down below that and just trading through the market depth again, when we lift up, 9 times out of 10 that is going to spur all of the market maker trading right there. When we see light trade cut through and back up, it's reload time. Okay, reload time. So what we're looking for is for the price of the period to basically move more than 4 price levels below the volume cluster. Okay? Once we get on the outskirts of that, that's when we start converting longs into shorts and longs into sells and things like that. So once we get more than about 4 points below, 4 price levels below where the majority of volume is, we can pretty much say, yeah, the sellers have initiated through that. They were unable to hold up where the volume cluster was. Okay? Now what we're looking for on commitment of traders here is we're looking for it to be less than the average market depth. Okay? I don't necessarily need to see a negative number when we uptick. All right? I mean, it's nice if we see that, and believe me, if you see the market break down and pull back up 4 or 5 price levels and you still have a negative commitment of traders, go ahead and short it. It doesn't happen very much, but it'll be a good trade. You know, it's worth the risk anyways in my book. But it doesn't happen very much. The reason is because in order for the commitment of traders to register, we have to have some sort of rate of change. So the directional movement would then be changing and we'd start to uptick. Well, if we're upticking, most of the time we're going to be printing volume at the ask. Okay? So my concern on this is not that it goes to negative 1,000 or negative 1,500 or negative 3,000. I just don't want to see anything larger than what the average market depth is. If I'm looking at the average market depth and it's 1,000 or 1,500 or something like that, then I don't want it to be much more than about 500 or 600. I want it to be less than what's going on, because that means that the positive gain off of the low isn't really all that strong. It's just simply orders coming in, and we ought to be able to drive through it. Okay, now before we're looking at a potential buy and we're saying we want to potentially buy near a presumable support level, well, if we're looking to sell a breakdown, we're not looking for the market to have just stopped somewhere like the bottom of the range. If we were to trade down to the low of the day today, and that's where I saw the bottom tick of a period where I see sellers initiating trade, I'm going to think to myself, hey, no matter how good that looks, that's not worth the risk. Why? Because a lot of times on very light volume we'll come off of the low of the day or the high of the day, right? And it'll just pop back up 2 or 3 points. So what I'm looking for is, when I see this, I don't want it to be a situation where we've just broken down and we find ourselves at the low of the day, and I get so excited because I see a pattern, I just enter the market. Right? I want there to not be any presumable support in front of me. I want to be 10 points from my target. Today I was looking to get long when we started moving out towards the top, because I had a target up around 35, 36. Okay, and we were only at 31. Well, yeah, I want to get long because I don't have anything in the way between here and there. But if we traded all the way up to 36 and then I saw buyers initiate trade, I certainly wouldn't be looking to get long until we got through it and I saw the pattern again. Again, we're going to look to put our entries on this near the high volume. The reason is because that's our expectation of where trade is going to be defended. Yesterday we talked a little bit about trade being defended. It doesn't necessarily mean that whoever's short is going to continue to add shorts. But they're not going to get out of their shorts until they're worried about being upside down. And if you get out of a short, you're buying. Okay? And so once we start seeing trade on the other side of where the majority of trade took place, it's too easy for it to get flipped the other direction. So what we want to do is position ourselves, in this case short, right in front of where all the shorts came in, and expect them to protect that position by not getting out and creating a fast momentum back up through them. Okay, so in this particular example, we trade down to the low, we back up, and we trade right back up and to essentially a couple of ticks in front of where the high volume is. Now, there is a way to trade breakouts and breakdowns, buyers and sellers initiating trade, with very low risk. The problem is that you'll miss an awful lot. Okay? I miss an awful lot, and you guys ought to know that up front. I'm a very conservative trader. I don't like to put myself at risk more than a couple of times a day, and I don't get my heart broken if I miss moves. There are some people that cannot handle that. They look at a chart and they go, my God, 10 points without me, I just can't believe that. Why wasn't I in a trade? This system sucks. I can't do this, blah, 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 blah. Okay, not me, not this guy. I'm too consistent. I don't care. It doesn't make any difference to me. So you'll have to determine where you sit on that spectrum. But to me, I don't mind missing trades. I just don't care. It doesn't matter. I'd rather have it be low risk, high reward. That's me. Okay? So in order to do that, when I'm looking for buyers or sellers initiating trade, I want the volume cluster to basically be 7 to 10 prices from the low. All right? I don't want it to be 4 or 5. Right? The third rule up here says more than 4 levels below the cluster. So from the 1179, 819 level, what, down 1, 2, 3, 4, once it broke the 915, 731, you could say, yes, the sellers are breaking this down. But I'm not really going to look to immediately trade something like that, because what happens is if I get in on the uptick back up against the high volume, then basically it may only be 2 or 3 ticks before we tap that low again. And 2 or 3 ticks is not enough for me to position myself very well. So I like for initiated selling to expand the market a little bit and allow me to have a pullback of a point and a half or two. Okay, and it doesn't always happen, but that's how I like to look at it, because to me it's a lot lower risk. I can manage it a lot easier, and we'll talk a lot about management tomorrow, and I think you'll really get it. But I mean, to me, the lowest risk way to do it is just to make sure that the market actually breaks down before you get too excited about selling into something. Now, a minute ago we were talking about presumable support for trying to buy something with responsive buying. Obviously, this would be the exact opposite, just like I said. I'm not going to try and, if I see the lowest tick of my auction, where I see sellers initiating trade come in right at the low, I'm not going to look to short that. It just doesn't make sense. But if we're a good ways from the next target, certainly. That's the idea behind being able to really establish a bigger picture. Okay, responsive selling. Obviously the exact opposite of responsive buying. What we're looking for is buyers being in control on the way up. So we need a probe upward. Okay, and ideally we want one that we can really track the volume in and see that there's a substantial shift. It's not just a huge clump of volume and then a huge clump of volume and then a huge clump of volume. Something where we can actually say, yeah, okay, there's maybe 6,000 contracts traded in 2 price levels here, and everywhere else, most I see is 1,800, something like that. So we want to see that shift up to the top, and that'll let us know that we've got a lot of longs that have come into the market that are not getting paid. They've put themselves in jeopardy. And obviously what we're looking for is those late buyers to get trapped. Okay? And if they have to sell to get out and that spurs momentum the other direction, I want to be short from the top. I don't want to be trying to get in where it becomes a shaky situation. The rules that we use for this, obviously a period dominated by buyers, and we would prefer to see light volume within the lower prices. And just as when we're looking for the long off of responsive buying, what I want to know is that if we do get into a short, there's not a whole lot of trade down below me that I have to worry about somebody protecting and not allowing me to trade through. I like the trades where you just cut through it like a hot knife through butter. Right? You don't have to sit there all day. The last couple of days we've taken trades that have just drug on and on and on and on. It's not how I like to trade. Time in the market equals risk. I'd rather get the job done very quickly, set myself up for a break-even trade, larger targets, and get the job done. And if it only happens a couple of times a day, that's fine, because I can take those opportunities and make a lot of money with very little risk. Sorry, I don't think I made it through everything there. Obviously, we want to see the volume cluster shift up to the top. Specifically, we want it to be in the upper 3 or 4 price levels. Okay? We don't want it to be any further off of that. It'll make it very difficult for our risk to reward. When we're looking for commitment of trader numbers here, we're looking for something to be smaller. This is a hard way to, I would say, larger than the market depth, but in negative. I don't know the easiest way to say that and have it make sense to everyone. But obviously we're looking for a negative number, and we want it to be more negative than there is average market depth. So that may be 1,000, it may be 1,500, it may be 3,000. But you have to be able to look and see what's trading in the market. And that's something you ought to be doing all day anyways. I mean, before you ever put a trade on, you ought to know, hey, am I even likely to get filled here? Is there 4,000 contracts in front of me? Should I go in a tick early? Obviously, responsive selling will be looking for presumable resistance levels, right? We want to target areas where we expect it to be very difficult for trade to continue through higher. And when we put in an entry, we're looking for entries near the high volume level. Okay? Once we trade back on top of that high volume, then those trades are profitable. So if I get in several price levels below the high volume, then it's easy for me to get trapped upside down. But if I position myself against those that are stuck, it doesn't take much for me to be profitable and for them to get stopped out. So it just comes down to risk to reward. And every trade is going to dictate something different. but you'll always do better if you can target right up against the high volume. Presumable resistance, exact opposite of what we were talking about before. You're looking for these patterns where you would expect it to be difficult for buyers to continue trading through, meaning previous ranges or other targets that we give you. Good job, Bob. Obviously, when we have sellers responding and they're unable to initiate enough trade to reverse the market or break it down, and buyers, in fact, initiate enough trade to get through those levels, we would say that there's buyers initiating trade, which would indicate the beginning of a breakout. All right. We have buyers push to a temporary resistance level, or a level where we can see there was a substantial amount of trade that took place in order to move the market any further. I mean, consider what's happened here. With 5,700 trades at the ask, the market wasn't moving, right? We don't ever see 5,700 contracts in the market depth, at least I haven't. Not at one price level. So what took place was buyers buying this up through the market depth and then hitting a point where the sellers said, hey, you want to keep buying this? Here, have mine. Here, have mine. And they kept adding to the supply. Okay? Now, in this case, eventually, the buyers were able to accelerate beyond that level. Okay? So what was temporary resistance now essentially is a line in the sand for us where the buyers initiated trade. So we want to see this volume cluster essentially be somewhere below, 4 or 5 ticks off the high. In this case, the market obviously moved up quite a bit further. But until we really see that all those shorts that came into the market trying to drive it back down are upside down, it's really not anything that we can jump up and down about, right? We can't get too terribly excited about it because, hey, if we trade up another tick and then all of a sudden the sellers start pouring in, we don't really have anybody upside down. But once those shorts that came into the market are too far upside down, they're going to start unloading. And usually you can see it exactly. You can spot the volume and you can say, look, there were 4,800 that came in here and 4,800 that came out right above it. I mean, it's amazing how you can see the numbers almost exactly identical. They're always 1.5 to 2 points away. I mean, it's just like perfect, and that's where the market will stop moving. Good job, Bob. So when we're looking at initiated buying, period dominated by buyers, obviously we're looking for the market to be moving up. And we'd like to see light volume at the high of the period. In other words, on the other side of the high volume cluster, we'd like for it to be fairly light. There's a reason for that, and that typically indicates that we're going to get a very fast pullback into where the buyers initiated, and we're going to have more buying, reloading, and carrying the market even higher. It happens like clockwork, guys. This is the most recognizable pattern, unfortunately one of the hardest to trade, but the most recognizable pattern that you'll see in the order flow is that when we get on the other side of something, if we trade through the market depth very quickly, it will retrace immediately, and I'm talking about within a few seconds, and you will see the market maker come in full force, buying up everything. So we need the price to move more than 4 prices above the volume cluster, so we need to have a high that exceeds the top point. And we want to see that the commitment of, God, this says 1,500, sorry, that's a typo. The commitment of trader level, we want it to be less than, I'm sorry, how would I do this? Negative, more than, I guess. Anyways, where we would normally be looking for a short, we would want it to be a negative number larger than the average market depth. In this case, as long as it's not larger than the average market depth. If we're down ticking, it's obviously going to be negative, but scratch through that 1,500 and write average market depth. So it's okay to have a negative number, meaning that there's sellers coming off the top, but we don't want it to be overwhelming. We don't want it to be larger than what we've got faced in front of us. Obviously, we don't want the high near presumable resistance. Okay? Um, if the market expands and we see the high run right up to the previous high of the day, it's a good chance that we're going to bounce back. Okay. You got it. No. Well, yeah. It should be less than the opposite of the average market depth. Less than the negative. You're correct, Johnny. Okay, and Mike, you make a very good point, and this is going to take just a little bit of explanation. Okay, let me switch to a whiteboard real quick so that I can properly explain this. And this is going to be one of the hardest things for you to get your hands around when you're looking at something past tense. Okay, when we see buyers initiate trade, we see them drive the market up to a level where they encounter some supply. Then what we see is them drive up very quickly through the market depth. Okay. Then we'll see it retrace back down to where the buyers initiated trade, and then we'll see it blast off. Okay. So if you look at the current slide, and you can imagine that taking place, unfortunately, whatever we see here has already had two paths, right? Up and down, correct? So these price levels have had twice, they've been traded over two times, as opposed to here where we're just seeing one direction. But this is where the rotation takes place. So historically speaking, looking at something, it's a little difficult because this may have been 900, I'm just making stuff up, 500, 300, whatever it was, and this may have been 300 and 200. But now it's traded up and back down, and so we've print double at both of these. So it's hard to see in hindsight, but essentially what you will typically see, and this to me is still fairly light. Okay, it's still, it's not overwhelming, and mostly because I would be really worried if I saw a tremendous amount of selling coming in on that side. Yeah. Okay. All right. So where are we? Commitment of traders. Yes. Johnny's got it actually on there, right? So if you want to just mark that down. But I think everybody understands that, or at least you should. And if you don't, I'll clarify. We want the high not to be near a presumable resistance level, not near the high of the day or the high of the last range. If that's where we just touched and started backing down, I would be very hesitant to go long into it. Nothing quite as painful as buying the high of the day. Again, we're going to target our entries near the high volume level. Okay, it's very easy to get into a mode where you just look for the purple line. Okay, it's very easy to do that, and while that's a great place to start, what we're going to teach you in the next couple of days is that it'll be very hard for you to get filled with a limit order here. Okay, and so typically what we're looking at is just above that, where do we see that the buyer really took control and that the seller gave up? Okay, and in this case, if you look at the high volume, it's more or less matched. But at the next level, 2,500 against 700, 600 against 200, really the seller gave up here. Okay, and the buyer engaged here. So most of the time what we'll be looking for is an entry right in front of where the high volume is. And the more practice you have looking at this, the more you'll realize where the actual volume cluster lies. Rather than specifically saying, well, there's a magical purple line on my chart. Okay? I think everybody could agree that these three price levels hold the majority of trade for this entire period. Okay, and just as I was saying about the risk involved with buying breakouts or selling breakdowns, for me, I'm typically looking at something where the high of the period has gone at least 7 to 10 price levels above. And the reason is because if I go long here and the high of the period were here, I could find myself going into a double top, right? And it's not to say I wouldn't do my best to manage my way out of that, but at least if I've got a spread between the high and where I'm getting long, I have the probability of that double top providing me enough room to breathe. Okay? And as I said, tomorrow we'll talk a lot about that. Obviously, presumable resistance, you're not trying to do this up against the high of the day. All right, so those are the four patterns, and if you can start to associate those things, every time you look at the chart and you say, what does this look like to me? What do I see going on, or what do I think's about to happen? Start to try and classify everything that you see. And as you see it and then something moves, and the most identifiable thing for you is going to be the high volume, because it's going to shift on you and you're going to go, whoa, this looked like buyers initiating trade and now it looks like responsive selling. And the only way you're going to get very comfortable with this is to do that a lot, all day long. So hopefully we see more movement than we did this morning. That would really be nice. But what you'll find is that for the most part you can classify any period that you see. Okay? However, we're going to start classifying groups. Okay? We're going to be looking at things and saying, let's try and understand what really happened between the supply and the demand in the market. And so it will require us looking at more than one period and being able to ascertain, hey, the seller initiated trade, the buyer brought it back up, but then there was a responsive seller at the same point and drove the market back down. Okay? So we'll get into a habit of looking at more than one period and trying to understand the overall bigger picture of the market. Well, when we look at several periods and we see that there's nothing that we can ascertain from it, okay? Nothing. I mean, the first key will be that we'll see all of the high volume levels starting to line up, and basically we're not making any headway. Well, what does this tell you? I mean, basically, if those were each 10 minutes long, we would be stuck in a very tight 2-point range, right? Well, I'm not looking to trade a 2-point range. Even if I get in, one tick off the high, my chances of getting to the other side and making a 1.5 points are pretty lousy versus what happens if it does meet the buyer initiating trade and driving through it. What's the risk to reward? So without some other instrument like volume profile or something like that, I'm typically not looking to trade a small range anyways. But if I can recognize that I don't see a pattern in here, I do not see something that I can say, yes, I understand where the buyers took control and started accumulating, and then I understand where they started distributing their contracts and taking profit, and the seller started taking control. And if I can't see that, stay out of the market. There's no reason to throw it away. It's too hard to do this when everything's in your favor, much less when you've got nothing in your favor. So when you start to see periods line up with all the high volume levels all in the same place, and you really just can't make heads or tails of what's going on, step back. And that's it's as important to learn when not to trade as it is to learn how and when to trade. No. To me, it looks like buyers initiating trade. But I'm glad you said that, Mike, because that's where we're going next. Okay. I'm going to ask you guys to participate, and you can choose to be the kid in the front row and do it, or you can choose to sit in the back. And I'm going to tell you, you won't get any freebies if you sit in the back, all right? what I want you doing is typing in buyers initiating trade, responsive selling, responsive buying, sellers initiating trade. Okay? Those are the only 4 things that we're going to look at. So I want you to participate. Okay? There's no harm in being wrong. In fact, if you're wrong, we'll learn a lot more from it. So we're going to go through a lot of examples here, and I want you to be able to identify this stuff, and I want you to do it again and again and again when you have time. Okay? So the first pattern, and I apologize for the artwork that's about to go on here, but it'll help if I draw this out on each one, and so it gets a little messy, but just so we know exactly what's going on. And you're correct, the first one is responsive selling. We have the buyers in control. We see the high volume shift to the top. We have buyers that are in jeopardy here, and at this point the market has rotated back to put them upside down. So we could say that this was a responsive selling effort, and we would be looking for the market to push lower after this. What do we see here, guys? Correct. Responsive buying. We have the seller breaking the market down. We have the high volume shifted to the low of this. We have sellers in jeopardy, and the close of this is here, so these guys are upside down. So this would be a responsive buying effort. Sellers initiating trade. Sellers break the market down. They're met with some sort of temporary support level here where it could have been responsive buying, but they're able to accelerate through, break the market down further. Sellers initiating trade. Correct. Buyers initiating trade. Buyers drive the market higher, meet a level that's a little more difficult to get through, they accelerate beyond it. What do we see here? Very good. Responsive selling. Buyers in control. High volume shifts to the high. We would expect this to potentially roll over. It's not a race, and believe me, if there's anybody in here, I can't tell, I see so many, but if there's anybody in here that's not replying or feel like you're going to type something stupid or waiting for somebody else, we got to get as much out of this as possible. And you know, so don't hesitate. Even if it's the wrong thing, we'll talk about it. And these may seem really stupid and simple right now. They're going to get a lot more difficult. What do we see here? Okay, Stephen gets the prize. Okay, so a little different. What are the characteristics of responsive buying? Number one, we would have to have the seller be in control. Does it look like the seller was in control here? Okay, no. This is the open. So when we opened, we downticked, and then what happened? We traded a lot here, and the buyer initiated trade, right? Now you're used to seeing buyers initiate trade with all the trade in the middle, right? But what's the characteristic of buyers initiating trade? That the high goes more than 4 price levels above the high volume, right? So you might be able to say, well, there was a responsive buying effort here, right? As we came in and tried to short down into it, and the buyers were met. But overall, this pattern tells me that the buyers initiated trade. Okay, for this, just like any candle, okay, because obviously, Eric, we're looking at past tense. So for any candle, we would have an open, a low, high, and a close. So current price would be the close, okay? So obviously, if it were a red candle, we would have, it would be the open here and the close here. Got it? Bueno. Let's move on. What do we have here? Now come on, just because I gave you a trick last time doesn't mean you get to quit. Responsive buying, correct. Sellers in control. High volume shifts to the low. We have sellers that are stuck here. We're looking for that to get rotated back up, and hopefully they'll get stopped out about right here. This is responsive buying. Very good, guys. Here's the open. We tick up, tick down. Little trouble getting through here, right? Nothing easy. And what do? We accelerate beyond. This is sellers initiating trade. Well, now that's different. What's happened here, guys? Let's look at them one at a time. We have the sellers in control. We have the high volume down here. So what happens down here? Responsive buying. What takes place? Comes back to the high volume, right? Then we have buyers drive the market up, find a little bit of trouble, and accelerate through. Responsive buying followed by buyers initiating trade. You will see this almost every day. Almost every day you will see this pattern. Okay? And what it is to signal to you is that just because you miss something like this doesn't mean you throw up your hands and you walk away. Okay? If you missed the first trade, and this is some sort of support level that you were looking for that morning, let's say this is your target here at 26, okay? And you see this come together, and not everything works perfectly. The commitment of traders doesn't get right, or you're uncomfortable about your trade entry because you feel like it would be too late, okay? What is this telling you? It's confirming this, right? You were looking for the market to move up. You wanted it to move up from here, and it happened. Well, this is telling you, hey, it's right. So you may have an opportunity when this breaks through, looking for it to come back and have an opportunity to buy it. And you may be more aggressive in a pattern of buyers initiating trade after you've just had confirmation. Yeah, it just happened for real. Okay. What do we have? Just one at a time. Okay, or two at a time. You guys are getting good on me. I don't want to lose anybody in the dust here, so if we're moving too fast, tell me. Buyers accelerate the market higher. A little bit of difficulty getting through here. How do we know that? Because 3,700 contracts had to trade there to move any higher. But we break through. Buyers initiating trade. Comes right back to the high volume. We trade back up. Now, this is interesting, guys. Where did we trade back up to before it became difficult to trade any further? The previous high, right? Yeah. Starting to make sense why it could be a little bit tricky for you to be buying breakouts that are right up against the high. Yeah. There's some temporary resistance there from the high, and it didn't trade through it without some effort. But buyers initiating trade followed by buyers initiating trade. What have we got here? Buyers are in control. I would say this is a fairly weak responsive selling pattern, right? I mean, there's just not a lot of trade here. But, you know, it's probably pre-market. So it is what it is. So we've got responsive selling here. Sellers initiating trade. Jenny, are you with me? Okay. No, that's fine. It's not a race. I just want to make sure I'm not going too fast. If I'm going too fast, tell me to slow down. And that goes for everybody. I just noticed that Jenny didn't post on the last one. Don't worry about my time or how much time we have. If we're going too fast, we're going too fast. I just need to know. Great. I think these guys are looking ahead at the slides in their workbooks. Responsive buying, followed by buyers initiating trade. You'll see this all the time, okay? All the time you'll see this. It's two shots at the same trade because this may rotate right back down here and you may have another shot to buy it. Well, on this one, Mike, you probably wouldn't because of how far it is. But like I said, you remember when we were going through the rules slide, and I said, as long as we go beyond 4 price levels, beyond the high volume, then you could say that this is buyers initiating trade, right? Okay. Well, normally I would tell you I wouldn't look for this to just trade up and then trade right back down and go long. Okay? I wouldn't look for that normally. Because to me, there's too much risk associated with the fact that you're going to get long right up against the current high. But when I see this, followed by this, if this was a level that I was looking to buy, and I, for whatever reason, didn't get into it, okay, if this was something from my morning analysis and I said, that's where I want to go long. If we get responsive buying there, I want to go long there. But let's say that I put my long order here after it rotated. Well, I get no fill here. Never trades back here. So perhaps when this was being created, I had an opportunity to get long at this downtick. I doubt it because there wasn't much volume trading here. But you're right. For the information that you have, you're probably looking to go long on the next auction. And it may not ever show up. Okay? This is a pretty strong confirmation of control. How we doing, guys? Everybody doing all right? Is this starting to make sense? Are we soaking in a little bit? Just okay, Stephen? Give me a little feedback. Are we understanding? Or we feel like you're getting the patterns, and maybe tomorrow you can look at your chart live and go, holy crap, I see some of this. Sorry about the language, Nancy. Okay, well, you've got them there for you. Very good. Thanks, Lev. Okay, Eric. Well, listen, make sure and go through this. And if you've got any questions on any of them, you get back to me, okay? And obviously this will be posted, this video will be posted for you to go back through. Yeah, I will. But this is really important. I mean, this is the most important piece of the puzzle because the rules you can read and reread. I want you participating in the room when we're doing this stuff. So I'll post it in the on the page where you log in, Brad. Okay, what do we see? Okay, well, I'm going to tell you that I like everybody's answer, including Mike's. Yeah, and you guys are all correct in terms of the pattern. Okay, this is responsive selling, and this is sellers initiating trade. Okay, but let's talk about why I would be hesitant to trade this. Looking at the volume that's taken place in this period, obviously there's a lot of trade up here, but there's not exactly no trade here, is there? Remember, one of the things that we're looking for in order to enter a trade is that we really want there to be light volume in the lower portion of this. Because if we enter this thing short, we don't want any trouble getting through it. Okay? We don't want any trouble to break it down. Now look what happened on the next period. You think it's any surprise that the market stopped moving right there? This is the last place that trade was initiated, and those buyers are profitable, right? So as we start trading down, it's no wonder that it took 4,000, 5,000 contracts to trade through this. So technically, yes, you're all correct. Responsive selling, sellers initiating trade. In this situation, it may have been advantageous not to take the trade up here, even though it worked out, and instead look for the sellers initiating trade and potentially short it once we see the breakdown. Okay? Tomorrow we'll have a lot of focus on stuff like that, but I just wanted to bring it to your attention because you guys are doing a great job. Stephen, I'm hoping that you just got those backwards. Okay. In the most basic fashion, we've got sellers initiating trade. Obviously a very large breakdown. Tremendous amount of trade here, right? Tremendous amount of trade. And breaking it down. All right. Now, what happens after the sellers initiate trade? The buyers bring it back up where to? To where the sellers broke it down from, and we see responsive selling. Put a star on this page. This is the most important pattern that you can learn. Sellers initiate trade, responsive selling, back up at the breakdown point. You can't get more confirmation than that, guys. You just can't. Maybe if after this we see sellers initiate trade again. But do I really want to be in the market another 4 points down from where the breakdown started? This is a strong move down. It found some support, broke down, and then on the way back up, the seller came in and said, it's going. This is ours. Okay? Let's look at it another way. You don't have any clue what the order flow is. You just like to trade when your little lines cross and everything else. Okay? And you see that the market is broken down and you get antsy because you're not part of it. And gosh, it just keeps crashing. It keeps going down. It keeps going down. It keeps going down. I'm going to get short now. Oops. Perfect opportunity for somebody to take advantage of you. Drive the market right back up to a point where let's stop that guy out and drive the market down. Okay? This is an important pattern. When you see this, trade it. Very good, Mike. What do we see? Okay? Sellers initiate trade. Notice where the next period starts. Right back where the sellers started the breakdown, right? Now, there's a little bit more to this than let's just look at the hindsight of things. Okay, because at some point the volume cluster was here, right? Would you agree? Based on the volume above this, at some point the purple line was over here. So while we could now say, golly, I don't know, sellers initiate trade, responsive buying maybe, I don't know what's going on down here. We know that what happened here is that after the breakdown started, we pulled back to the high volume, we traded down, had a little bit of trouble here, and then sellers initiated trade through it. And now what we're finding is we're down here, and technically speaking, 1, 2, 3, 4 price levels beyond the high volume, right? Technically speaking, we're probably still there. But if we look at where most of the trade takes place here, I would say maybe here. I'm not going to try and short this. I'd be looking for it to break down a lot further, right? So the key was to get in here after the breakdown and possibly here after the breakdown. But now that we have all this trade, phew, you know, I'm not still looking at this as sellers initiating trade. This to me is a big question mark. I don't know what to do with that. What have we got? This is the trade that you long for. This is what you want more than anything when you're trading a number that you recognize, right? If I can see up here that there is some sort of support level that I want to short, and I see the responsive selling come together, my biggest dream is that all of these guys get stopped out right here, and then the market maker pushes it down because the sellers initiate trade. That's what you want out of a reversal. Very good. How about here? Well, starts out with sellers initiating trade. They break the market down. This is all very light volume. So as it pulls back up, this is where you'd want to short. Don't think we'd get filled here, but you know, that would be the idea. And then we see the sellers break the market down. And what? This is responsive buying, right? So if we have a short, this might be what we would say is our target, right? Wouldn't that be the market telling us, hey, maybe it's time you take profit? Does that make sense? Anybody other than Tony get that? Thanks, guys. Don't hide in the back of the class. Okay. Sellers break the market down. Looks exactly like the last one, doesn't it? Sellers break the market down. Now, do we see a tremendous amount of volume down here? Yeah. Again, you've got the high volume level at the low. But do we see a cluster of trade here that warrants us doing anything at this point? Probably not. To me, what I would say is if we were lucky enough to be in a short from this, this is something that we would probably allow to develop a little further. Yeah, hold the short. Very good, Stephen. I have no idea, Lev. This to me looks like, well, yeah, I mean, this is the pattern that we look for. Light trade, and then the market makers accelerating the market. This looks like pre-market to me. The trade is so light here that I just can't imagine. Either that or it's 8:15. Duh. It is pre-market. Responsive selling. Sellers initiate trade. Did you miss it the first time? Sellers initiate trade again. Trade entry, trade entry. Very good. We start off with sellers initiating trade. Okay? Now they don't bring it all the way back up to the high volume. All right? They don't bring it all the way back up, but we can see in this where really the buyer gave up, right? All through here we still have active buying. And if we look at it like this, if I were to tell you to pick the 3 or 4 price levels which hold the consecutive price levels with the most volume, wouldn't you say those? So technically speaking, although we didn't exactly trade all the way back up to the purple line, we did trade back up into the high volume. Okay, and really where we see the differential come in is at this 1500 against 355, right? This is where there's no buyer participating and the seller's breaking the market down. And these are the kind of things that we're going to talk a lot about tomorrow with getting your entries down just perfect. Because if we just simply say limit short up here, a lot of times we're never going to get there. Okay? So sellers initiating trade, coming into a responsive buying pattern, which would indicate taking profit. And then what do we see? A pullback and possibly an opportunity to short again from a better spot, right? Okay, Jim, we'll see you in a little bit. All right. Don't be afraid to post a question mark, because you're not going to know what they all are all the time. But I'd say Tony's pretty much on it. We could maybe even call this responsive buying. I don't know. This is the kind of thing that we won't see very often, but we do see it. Okay, so we've got the buyers driving. Let me just start over. Buyers driving the market up, bringing it back to the high volume. We've got the sellers trying to bring it down, but ending up giving up. So we could call this responsive buying or say buyers initiating trade. I'm going to give this one a question mark, but I don't think there's any confusion about what the effect is. Buyers initiating trade. Hard to say, Brad. There was a rotation off of this, which brought it back to here. And apparently there was enough of a probe, I guess there was enough downward probe here. It probably ticked up and then came all the way back down and then up. I don't know the answer. Yeah. Okay, Tony, that's probably as good as any. Yeah, same with you, Stephen. In this case, we've got a situation where the sellers are bringing it down, and we see that there's a responsive buying effort. It's fairly clear. But on the next one, based on the amount of trade here, it really looks like the sellers tried to bring this down again, right? But we're unable to. In other words, the buyers responded. So I would say that because of how this came together, it's most logically responsive buying, but I don't know that for sure. This is a difficult one. We'll call that a question mark. Okay. So if hypothetically I'm long from somewhere down here, this is basically telling me it's time to take profit. Yeah. Okay. Pattern to avoid. You could say that. The most important thing is that, if you can get the big pictures here, things like this are going to come together when you're watching it live, because you're going to see the price open and start trading lower. After the fact, yeah, it looks like a doji. Well, I guess it is a doji, but when you see that it's a push down where the buyers respond and drive it back up, pretty much you could call it what you want, but you know what you ought to do with it. And Brad, you will have more time when it's live, and if I'm going too fast, that's perfectly fine. We'll slow it down. Most of the time, this stuff doesn't happen really quickly. Okay, well, if I'm even remotely moving too fast for you, we're going to slow it down. Okay. Here we've got the seller driving down, so we can definitely say that this is responsive buying. Okay. And on this one, it becomes questionable. And so don't get worked up over stuff like this, because you could call this pattern either way, but at the end of the day, if we say that this is responsive buying, or if we say that it's buyers initiating trade, because technically speaking, it's moved up more than, well, it's 4 prices away from the high volume. Okay. Does it matter which one we call this? Would it make any real difference in real time? No. Why? Because they're both buying patterns. And the big deal is, were we smart enough to see this? Okay? If we saw this as our buying pattern, both of these confirm what we're doing. Right? If you're long and you see a buying pattern, even if you can't decide which one it is because the damn thing's too small, but you recognize what's taken place. I mean, you call it either way and you say, shoot, I don't know. It's either the buyer's initiating or it's the damn responsive buying. I heard buy in there 2 times and I'm long. That's good enough for me, right? Well, okay, Mike makes a good question here. What do we do after responsive buying if we have something that's questionable? Okay. Remember, today we're not talking about trade management or entries or anything else, but you have this beautiful little tool called the Trade Tracker. It's going to tell you as much as anything else. Okay? And I've specifically taken all the commitment of trader numbers off of here because I didn't want any confusion on this. All right? So if you've got a huge positive commitment of traders down here, and you've got commitment of traders, your trade tracker's positive, you just bought and you've got a questionable, it's either a responsive buyer or a buyer's initiating trade, I don't know. Okay, well, the reason I'm saying it's questionable, Brad, is because this is very clear what it is. But here we have a situation where we opened, we traded down, traded the high volume at the low, and traded back up. Okay, so I would say it's responsive buying. But if you want to take this on a technical level and say, well, the buyer bought up from the high volume here, you could say it's buyers initiating trade. I mean, we're getting a little too technical here. All right, it's just not something that you're going to see very often. But I have to throw this kind of stuff at you guys because, if you think everything is picture perfect and smooth as glass, we're not going to get anywhere. Yeah, yeah. Like I said, I don't really think it makes any difference because if I recognize what this is and I get long, if I'm going to argue with myself whether this is responsive buying or buyers initiating trade, I'm missing the point that both of them are confirming my trade, right? Would everybody agree at least with that? Beautiful. Let's move on. We got a long way to go. All right. Buyers initiate trade. Now, remember me telling you to star a page and how important the pattern was? That was a situation where we had sellers initiating trade followed by responsive selling, right? What do we see here? Buyers initiate trade followed by responsive buying. It's a critical pattern to be able to spot. Okay, and the reason I say that is very often when you've got something like this, you'll be targeting an entry like here. Okay, it's where I would be. It's where I would have gotten long. Okay, and then, oh my God, the end of the world is coming. I'm upside down 4 ticks. I have to make decisions. Okay, I have to make decisions. Do I take a stop out? My God, what am I going to do? I'm upside down. It's the end of the world. Okay, well, not if I recognize what starts to take shape. Because unless this breaks down further, I'm okay. In fact, it's exactly what I want to see. Maybe went a little bit further than I wanted it to. But if I start seeing heavy trades start coming in below this, I'm in trouble. But as long as we're seeing that trade getting on the wrong side, now this is responsive buying. And I can stomach it instead of just saying, let me out, get me out of this. You know, instead of throwing it away or taking a stop out, this told me to buy. This told me you didn't get in quite right, but you're still good. And look at the response, guys. Now we have buyers initiating trade again. Whenever we've got a buying pattern followed by another buying pattern, and particularly like this, buyers initiating trade, strong move, followed by responsive buying, it will always end up in a strong move. Very, very good patterns. Responsive selling up top. Sellers initiate trade. So if I didn't get it up here, actually, ooh. Okay, Gov, take care. Could say entry and target. Buyers drive the market higher. You see responsive selling. Okay. Then we see kind of another pattern of responsive selling. What would you consider that to be if you were looking at any other chart? Double top? Anybody ever heard of that? Okay. We make a high, we back down off of that, and we make a second high. right, let's look at this. First time up, we have the buyers engaging. We have 1100, 800, 300. Okay, and they don't get through. We see the responsive selling. Okay, second time up, 600, 300, 100. Are these guys still really trying? Or are these people not? Do these guys not have the same information? Whenever you see a double top forming with two responsive selling patterns, if the second one has less volume than the first, and I mean by the buyers, okay? Did the buyer try and drive it up the first time, and then the second time their effort was with less? If you see that, sell it. Responsive selling, double top. And the main facet here is that there's less volume by the buyer than there was the first time. And again, now we have a responsive buying pattern down here, but I mean really this isn't all that much. So really we're looking at this as probably something that we need to hold and wait and see. Here's an interesting one. First pattern's responsive buying, and I'd say probably one of the best ones I've seen. Very, very light trade, with the bulk of the trade taking shape down here. Shouldn't be difficult to get through any of that, right? If we can get an entry off right in front of this, shouldn't have had any problem getting filled there. Buyers drive the market up, maybe a little bit of trouble here, and then drive it all the way up through the top. Wow. Okay, well now we see responsive selling. And pretty much immediately this takes off down the other side. This is very, very light. Sellers initiate trade and just trade through the market depth. How would this be buyers initiating trade? When we have the buyers drive the market higher, and then we have a lot come in late and make it top heavy, we're expecting it to roll over. In this case, roll over that way. Okay, well, yeah, if you're going to ask me if at one point was this buyers initiating trade, the answer is yes. At one point this was certainly the high volume level, and they accelerated through it. Correct? But what happened? The condition changed. So if I didn't get long here, and I saw this take place, and I didn't get long when the high volume was here, and I told myself, okay, well, I'm going to get long the next time it comes down. When this shifted up, the condition changed. And I would say, I'm not looking to get long anymore, correct? So yesterday somebody was asking me about identifying this stuff in real time. Okay, well, the conditions for which you're going to be looking to get into a trade are going to change. You know, this could have very easily turned into sellers initiating trade. Yeah, well, with any hope, Brad, we were long here. Jenny's pretty close. This would be buyers initiating trade, right? Why would it be? Because the price moved beyond the high volume. It's all right. This is a tough one, Brad. And the reason this is here is because this is to teach you guys something that is very important about getting too excited about buying breakouts. Okay? If you just said, yes, I see it, it's buyers initiating trade. They traded up on fairly light volume, they broke out of this sucker. I'm buying this thing right here. Ow. Ow. What if you did the exact same thing here? 1, 2, 3, 4 price levels below. Gosh, this is sellers initiating trade. I'm selling this thing right here. Ow. 2 stop outs where you would have just bought the high and sold the low, right? This is a double whammy. I wish Eric was here because this is one where I'd agree. Oh, Eric, you are here. I'd agree with you on this one. My God. Right? Okay. Well, that's a great way to look at it, all right? I like that. That's not the answer I expected. Very good. Okay? All right. Well, I'm not going anywhere, Brad. I want to talk more about it, okay? Because what I was telling you when we said the rules for buyers initiating trade and sellers initiating trade, I told you that the risk to reward will be exponentially higher if you do not allow breakouts and breakdowns to expand at least 7 ticks, okay, if not 7 to 10. And the reason is because we're talking about trying to find trying to find the cluster of volume here. And in this, I see one price level, right? That's it. That's the only one with any trade on it. Maybe we could say the next one. Okay, so do I really feel like anybody initiated trade here? I mean, to me, it looks like it just traded straight up through this, right? And so what I'm looking at is saying, all right, well, if I'm going to get long in front of the high volume, let's just say I'm bold and I go here. I've just bought 3 ticks off of the high. Oh, you better have some brass coconuts to do that. Okay? I don't buy the high of the day. I hate that. Nothing will put you in the dirt faster than doing something like that. It's not just a stop out, it's one that burns, right? So I like to see the market expand when I see buyers initiate trade by at least about 7 ticks. And that usually puts me in the boat where I have to buy this on the next rotation, okay? Yeah, and so to me, really what happens here is this, in hindsight, looks like buyers initiating trade, but in reality, by the time this obviously happened pretty quick. There's not much trade. By the time this rotated off, you probably were sitting here going, ay, 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 is that responsive selling? Is that buyers initiating trade? In other words, the buyer never really came back in here to expand this far enough for you to really pay attention to it. Now that's if you take a very conservative approach to breakouts. If you look at this and go, they're running, I got to get in, this would have been an ugly stop out, okay? It would have been, and maybe Eric's right, maybe you could afford a 5-tick stop or something. Most of the time I wouldn't expect any of you to ever take that trade, and I'd hope that I don't. And probably the same with this, as to me, it's just too easy to go down and double tap a low or double tap a high. It just happens too often. So if I can't give myself a spread of 4 or 5 ticks where I know I can at least get the advantage on the market before I hit something and it stops like a wall, I won't take the trade. So probably out of all of this, there's no trade to be taken, and we would say that this was buyers initiating trade that failed. sellers initiating trade that failed, and buyers initiating trade that carried on. Okay. What is this? Right. Would we trade it? Be pretty tough, right? Be pretty tough to take this. Yeah, maybe. And you know, guys, that's going to be a big part of you becoming discretionary traders and taking some ownership of what you're doing. And nobody expects you to do that day one. All I can do is tell you what I do. But yeah, this would be tough. Very, very tough. Because I just don't see how you could get in here and not think that it was going to be a little bit difficult to trade back through that high. And I don't trade for 2 ticks, you know? I just don't. But what I can see here is much more clear. And I can see responsive selling here. It's a lot clearer to me than what I've got over here. And obviously down here we've got responsive buying. Sorry, let me go back. How do I know the 30? Well, I don't. I don't know that at all, Brad. All I can do is tell you what I see. What I'm trying to do is create a hypothetical for you, and all we can do is work with what we've got. So I apologize for that. Welcome back, Lev. Buyers initiate trade, right? Where does it trade back to? High volume. What's the problem here? When this was pushing down, this very easily could have been sellers initiating trade, right? As Brad says, we don't know what happened. It could have all happened on the pullback. But if I've got a long here and I've got something telling me to go short, I don't want any part of either one of those, right? Probably nothing I can get into. But what I see here is responsive buying. So it may have taken a few minutes for this to develop into something that I can look at. Now, why would this be important to me here? I mean, if I see this, and I know that earlier I was thinking, well, shoot, I can buy up against the high volume, and I tell myself I don't want to because this thing starts looking like the sellers are going to break it down. But then what do I see? The buyers bring it right back up. And then I see the sellers bring it right back down, and I see a bunch of sellers getting trapped where I originally wanted to get long anyways. Yeah, I might be able to take this. Okay, and I don't know, because here we are, you know, with the beauty of knowing that this ran 5 points. But I'm going to tell you, if I was looking to buy this the first time, I'd have said, heck no, that doesn't work for me. Second time around, maybe. Maybe so. Because it's still exactly where I'm going to consider there to be the most logical support in the market. Because why? This is where the buyers initiated trade. Sellers initiate trade. We see the responsive seller come in right back up at the high volume level, right? I think I've just about worn out the memory on my computer. So if we crash, that's why. We're drawing a little slow here. Well, it certainly can, but remember, I mean, no. What we're doing here is trying to interpret these as they come. And the first thing that I see is that the sellers initiate trade. So if I couldn't see anything over this way, if all I could see was the first period, I would be looking to short this thing, okay? And I would probably get into this and have to take 4 ticks of drawdown, okay? And it would probably start to worry me, except that this pattern starts turning into something that makes me feel a little bit better. So I'm short from here, and I've got a pattern that's telling me, yeah, sell, sell, and then the next one is confirmation, sell, and then the next one is confirmation, sell. So am I going to enter here because I got 4 legs of confirmation? No way. I mean, I want to get this trade when I first see it. But if the whole time, every consecutive period starts telling you, hey, you're doing a really good job here, then stick with it. Right? No, and listen, this is static. This is the first time that I'm asking you to call these things out. What are you going to do tomorrow? You're going to immediately look at your chart and start doing it. And Eric, you hit the nail on the head, my friend. Okay? Every time that the high volume moves, it's going to change your perspective. Okay? And that's critical because you can be so excited. Oh my gosh, I can't wait to take this short. Look how beautiful it looks. And then you get filled and the condition changes. How do we deal with that? Do we still sit there and go, I hope that this short works out? Absolutely not. We can't. Okay, so this is your exposure to what these patterns look like so that you can start practicing. And then as the day moves on, what do I see right now on the chart? I see buyers initiating trade. What happens if we print a whole bunch of volume at 3150? It's going to look totally different, isn't it? And that's what being a discretionary trader is all about, is being able to make consistent decisions. Okay? It's not about, oh, I feel like the market's going to move up or down. Forget about that. But if we provide you with a set of rules where you can say, when this is this way, I know how I should be looking at the market. And when that changes, I can't hold on to that the same way I did when I said, I want to trade with a 2-point stop and a 4-point target. Right? Then you can just hold on to it and blame your system when something doesn't work. But if the condition changes in front of you and you can recognize it, you can say, do I really want to take a 2-point stop, or would I like to take a two-tick stop and just get the hell out of this because it doesn't look good anymore? Okay? Very empowering to be able to make those decisions and do it the exact same way every time that information hits in front of you. Okay? Responsive selling. Sellers initiate trade. Looks like responsive buying to me. If you were short into this, you would probably be looking at this as a good time to maybe get out. Possibly not. The sellers come back and sellers initiate trade. You've had 2 really slow days, and I know you were here for some days before Christmas, so you know, it's an opportunity for you to see a lot of things and be able to Yeah, well, that's the goal. That's what you paid for. Okay, so what have we got here? This could be, yeah, failed buyers initiating trade. Again, very low volume in comparison to, I mean, this is not something that really stands out as being a huge cluster of volume. Questionable whether or not we'd be looking at this. Okay. Yeah, and I don't mean it like that. I don't mean like it's low volume, the number's small. I mean that I cannot find consecutive price levels here that I feel really warrant my attention. I mean, if I had to isolate the three largest, they'd be here. But, are they substantially larger than the 820 or the 986? No, I mean, yes, there's a volume cluster here, but bleh, you know. Same thing down below. Then we see the buyers initiate trade. Ooh, buyers bought this thing up, never looked back. This would have been a high volume at some point, but they never even looked back until they get up to a point where there's responsive selling. Yeah, I can't tell you that I would have been able to take any trade on here, right? But guess what, guys? That's life. You're going to find that a lot of things, you should be happy that you can recognize the overall direction, okay? Because if I look at this and say, I think the market ought to continue up, right? I can't trade it, but I think it ought to. And then I see it break down, and I say, well, son of a gun. All right, well, that didn't pan out. And then I look at this and say, well, and they're not continuing it from here. Then I see the buyers engage the market. Well, shoot, they've left this in the dirt, right? And then I see the buyers engage the market, and they've left this in the dirt. And then I see this, and I can finally start to make a decision. Okay, so this may be a lot of garbage to you because you can't get a trade off of it. But the bigger point is that you can look at this and say, okay, I don't know what's going on yet. I don't know what's going on yet. Okay, I see something. Responsive selling, sellers initiate trade. Responsive buying, responsive selling. Whoa, a lot going on here. Yeah, Mike, I mean, obviously I'm giving you things that don't even have a price scale, okay? But we're going to our expectation is going to be that you start the day with a strategy every day. Where am I looking for this to happen? Remember, we talked about presumable support, presumable resistance. Thursday is going to be all about that. Responsive buying followed by buyer trade. I don't know what the heck to call that. All I know is that when we closed, we were on top of most of the volume. Can't be horrible. Buyers initiate trade. All right, well, I'm happy that I'm long if I'm long. And then double top, right? 2 shots up at the high. Probably a good time for me to close my position if I'm long down here. Okay, guys, that is day 2, and I hope that that was enlightening. I know that there's a lot there, and if you feel like we went too fast or we missed a lot or, I don't know. It's hard for me to keep up with as many people that are going, but most of you guys were hitting them really, really fast, okay? And that's what I want you to do is challenge yourself with this. Go back through it. Go look at them and say, look, this looks a little iffy. There's going to be things like the buyer initiating trade that failed. I want you to be able to recognize that. Don't just look at where the purple line is. Look at the volume that's in there. Start to associate the things that we talked about yesterday and today as something that you need to be able to do live. Obviously, things are going to change. Just because it looks like something at 1 minute doesn't mean that the next minute it has to look like that. Just because the little purple lines in the middle of the period doesn't mean that we can't have something that looks like responsive selling. Look at the current chart right now. See if I've got it up. No, it's not up. In the current chart right now, we have a period where there's a huge move up and all the volume looks to be in the middle of the period. Okay, but if I look at the top, there's 12,000 contracts that are stuck at the top. Huge commitment of trader number. Looks like responsive selling to me, even though the purple line's in the middle of it. Okay, those are the things that we have to establish. Is look, just because it looks like there's a lot of volume in one place doesn't mean that that's the only place in the period we have to worry about. Okay, so don't just get into a color-coded mindset. Test yourself. Work it over and over and over. Ask questions. When you see things in the room developing, say, hey, DB or Bob or Bones or GK or anybody, ask these guys. Everybody in here will help you. Everybody will. It's important that you engage the room and don't ever feel like something's too stupid or that you don't want to ask a question, because if that's the environment that I'm creating for you, it's horrible. Okay? That's just horrible. Tomorrow we're going to talk about trading the order flow. So far you've had foundation, you've had some pattern recognition. You're asking me, how the heck do we know when to get into a trade? Okay, you're telling me this is a pattern, this is that. Come on, yeah, tomorrow that's all we're going to do. Trade entry, stops, targets. Okay, we're going to talk about how you can use the algorithmic assisted entry, how we use trade tracking. Okay, and I'm going to give you a basic strategy to get you started with this so that we're not just throwing money away because you think that, well, if I just trade this week, then I'll make enough money to pay for this class. Okay? There's no reason to start out at a deficit because you weren't willing to take the time to learn this. All right? So we need to give you a basic strategy to start with. So as much as we covered today and as many patterns as we looked at, we're going to do the exact same thing tomorrow, but you're going to be telling me, would you take the trade? Where's the entry? Where's the stop? Where's the target? Okay? It will be your aha moment. All right? It will. You will open your eyes and say, I never want to trade without this again, ever. I'll never put on another trade if I don't know where the volume is. And if you don't say that tomorrow, we need to talk. Okay?